Hi, Ed. Thank you very much for joining us today. How are things in Hawaii?
It's 75 and sunny as usual.
It can't get any better than that.
It's winter here, so we have to maybe put on a sweatshirt at night.
So the last time we spoke, you were looking for a significant pullback in the U.S. economy, and I just want to get your views. Do you still believe that? And if so, why?
Yeah, so let's talk about what we were looking for and how we ended up being wrong, but we reverse engineered why we were wrong, and a lot of economists were wrong as well. Our economic cycle indicators were looking for a recession at the end of 23, beginning of 24. That never materialized. And we looked at the back testing of our data, and it had been pretty accurate for 20 plus years. So we asked ourselves the question, well, have the laws of economic fundamentals changed, or did something else happen? And the answer is something else happened, and it was not long-term sustainable, and all of the new administration's policies are going to unwind. For your audience to understand, the economy was juiced by record deficit level spending, crisis level spending, 8% deficits to GDP. The last time we had that was the great financial crisis. So there's just to give you an idea of what kind of deficit spending we've been doing. We're at 2 trillion now. So you ask the question, well, what was the crisis? Well, the crisis was to get the Biden administration elected again. And there was a couple of ways they did that. They increased government spending massively. And what people don't really understand the significance of this in the economy was the illegal immigration, which we're now finding out, and we kind of suspected was a very purposeful, massive logistical undertaking funded by the government and NGOs. The NGO system is starting to be exposed. It's unaccountable, government organizations that pump money into the economy, and what they were tasked to do was bring illegal aliens, which distorted the economy. Net legal migration is 1 million a year. Okay, we brought in 10 million. Border encounters were identified. There's probably another 5 million. Let's just say that kind of snuck in under the radar. So let's call it 10 to 15 million. In our report that we issued, the U.S. economy 2025 dangers of a deep worldwide recession, we used 10 million for our calculations, just using the official statistics. It's a massive distortion of the economy. These illegals. So the economy was floated by NGOs getting paid, so they got their salaries. That stimulated the economy. Then direct benefits and accommodation were given to the illegal immigrants. Some of them found jobs, and there's evidence that was the case because they just revised the household employment survey up 2.2 million people with a population adjustment. So that was a big surprise. Well, not a surprise to us, but a surprise to many. The readjustment of the household survey this Friday with the payroll report. So velocity of money was increased because when you're super poor and you get direct payments, you immediately turn around and spend them into the economy. So it was very stimulative short term. And so this 2 trillion in deficit spending, according to the new administration's policies, they're going to try to tackle that by 2 trillion. Doge, the new Department of Government Efficiency, has already identified 1 trillion at least they think they can get out. So all of the juice, the short-term juice we saw going into the election, is going to reverse. And that's not a bad thing because the beneficiaries of that short-term juice were owners of financial assets, the very rich and the very poor. The middle class was getting inflation, and their real wages decreased -2% going into the election. And that's why the new administration won, basically. If you go back to 1980, Ronald Reagan won with a -2% real wage growth, and Bill Clinton in 1992, and that's when James Carville famously said, "Is the economy stupid?" So the middle class has already been in a recession. There's been the payroll numbers have been suspect. They were padded with, statistical incompetence or fraud, whatever you want to call it. It looks like very low wage illegal immigrant jobs and government jobs. So it's three things: legals, government jobs, and some statistical padding. And the economy obviously has been weaker than the headlines report. GDP numbers are going to be revised down. as we roll through the next calendar year. And it's already started to happen. The Bureau of Economic Statistics started revising income accounts down. So we'll start to see GDP numbers revised down, and then we'll eventually get a negative GDP number. We put out a follow-up report to our big report as just to give some of our subscribers and those who can buy it individually a heads up that we think our thesis is already unfolding. New tenant rents came out in January. They plunged in the fourth quarter. It's a very, very volatile series. So, but it was a big enough plunge that even if we, get a revised half of that back up, it's still a very, very bad indicator of where, home prices are eventually going to go. New tenant rents feed into all tenant rents, gets into the shelter calculation of CPI. So just that alone, we think inflation is going to be sub 2% by the fall, just on that one indicator alone, if without anything else changing. So that's where we are. We think there's, in our report, we talk about how we think that this is going to be a little bit like 2008, 2009. Housing prices will adjust. Home affordability is unattainable at the moment, given where mortgage rates are, where home prices are. And there's, if you talk to anybody in the real estate business, transactions and pending home sales are at record lows in lots of different regions throughout the country. So that's kind of where we are. The other thing we talk about in our report is global real estate prices have already started rolling over in real terms. So we get problems in Europe, and we definitely get problems in China. And that's going to, the rest of the global economy is already slowing. Those GDPs are either flat or rolling over, and that's going to eventually feed back. The feedback loops will come into the U.S. The U.S. is stagnant, and that's going to be very impacted by the outflow or the halting of illegal immigration. Now, people say, hey, they don't buy new homes. That's correct, but they rent. And rent holds up home prices because a lot of people have other properties that they rent out to people, and those new tenant rents are a leading indicator.
You mentioned a lot of things that I want to comment on, but first of all, I want to start with immigration. I'm based in Toronto. I'm not even American, but what the Biden and Harris administration did with the immigration policy just astounded me. And I was even pissed off by watching what was happening there. To let 10 million people just to flood into your country and not even know who they are, where they came from, what their intentions are, is just craziness. But we also have an immigration problem here in Canada, except a lot of the people that came here didn't come illegally. They actually came through the proper channels, and our government, the Liberal government, allowed too many people in a short period of time. And just to give you an idea, in 2023, they let in over 1 million people, half of which came into the city of Toronto. Toronto has a population of 5 million. So our population grew by 10% in 1 year. You can imagine the stress that put on the infrastructure, the healthcare system, education, transportation, and everything else. And the big problem is the people they let in, they're not contributing to the economy, right? The taxpayers are paying for them. So this has had a big drag on our economy and also on the productivity of our economy.
Your audience needs to understand it's very inflationary. And, a sudden increase in illegal immigrants is very inflationary to an economy. And that, in addition to the money printing by the Fed during the COVID years, illegal immigration, or in your case, legal immigration, but done too fast, adds to your inflation.
Yeah, 100%. We have seen significant increases in inflation here. I just want to touch on inflation for a moment before I ask you about something else. But in the city of Toronto, property taxes went up 6.9%. It was just announced for 2025, 6.9%. In the last 5 years, Ed, in the property taxes in Toronto have gone up over 25%. All right. Just think of the burden that's putting on individuals. Like you talk about housing affordability, never mind buying a house, people can't even afford to pay their taxes, property taxes. But you touched on unemployment, and I want to ask you about this. The unemployment rate in the U.S. bottomed in April of 2023 at 3.4%. It's been ticking higher ever since. The latest number came in at 4%, down from 4.1% in the previous month. However, the number of jobs added came in at only 143,000 jobs versus expectations of 169,000 jobs. Do you think this is the beginning of a significant pullback in unemployment? or I should say a significant increase in the unemployment rate?
Yeah, it's inevitable. Capacity utilization and PMI, which are good leading indicators for the economy, have been bad for the better part of a year. And as the new administration's policies on immigration have their effect, that's going to start to cause issues in the employment numbers. Plus, the statistical padding that we have found, the birth death model is just wrong. Um, Other economists have found that there's a huge statistical difference between the QCEW, the quarterly census of earnings and wages, and the establishment non-farm payroll number. They're both done by the same government agency, the Bureau of Labor Statistics. None of us ever cared about that report, and the reason we didn't is because it's the book report of the non-farm payroll. It's the actual reality that by law, 16 million companies need to report, employment and wages by law, but that takes time to collate, and it's a lag. The last QCEW came out in June, and the establishment survey only surveys 600,000 employers, so it's an estimate. And there's a birth to death model, and what we found, and other economists have found, is that the difference between reality and what they reported was a 7 sigma standard deviation to the downside, meaning jobs that weren't there, 1.25 million. And so the question is, what's going on? The QCEW was so alarming that the Bureau of Economic Analysis, which is a different agency in the US, but also uses the data from the BLS, had to revise down some gross domestic income accounts. So and even the Federal Reserve, Jerome Powell talked about this. There's been a lot of questions about the employment numbers, and to the point where a lot of economists don't even trust them anymore. And that's why we now look at the QCEW, a trailing indicator to find out what happened in reality.
Yeah, well, when it comes to government data, I mean, you have to start somewhere, right? You got to use that
Right.
information as a benchmark. So, but whatever the number is, I just double it or I cut it in half. So if it's the unemployment rate, I just double that, and if it's inflation, I just double that too. And if it's a GDP, I just cut that in half. But
Yeah, the BLS in the latest payroll number on Friday revised their March payroll estimate by 600,000 jobs down. When you look at the allowable band of error, they have plus 0.1%, minus 0.1%. This was minus 0.4. That's a 5 sigma difference. So, you can say it's fraud or bureaucratic incompetence or a combination of both. But that was about 50,000 jobs to the upside during 23 and 24.
you mentioned that there's a middle class recession going on, and all through 2024, a lot of big companies, when they came out with their earnings, they were saying that the consumer was hurting. And we saw it at McDonald's and Starbucks and Costco, Walmart. And it's interesting to see in the last few months, a lot of these companies have come out with revised menus. McDonald's, for example, has a $5 meal deal. Wendy's has a $3 breakfast bundle. But still, the best deal anywhere is at Costco. You can still get a hot dog and a drink for $1.50. I take my family there at least once a week. But I think these are indications of what's happening within the broader economy. People are really hurting.
Absolutely, and that's why the new administration won. And in fact, I would contend that a recession is proof positive the new administration's restructuring the economy. If we see government spending continue at these levels or accelerate, then we know that it's kind of the same old boss, in my humble opinion.
So you also touched on government debt. And when Trump came to power in 2016, the federal debt was at 19 trillion. The deficit was 3% of GDP. Now the debt stands at 36 trillion. It's growing by $1 trillion every 100 days. The deficit is somewhere between 6 to 7% of GDP. And Scott Bessent has said that he wants to get the deficit down to 3% of GDP. Do you think that's possible in the coming years?
Yeah, so there's two ways to do it, right? You cut spending, and then you also have economic growth. So you get more revenue. So the idea is there's going to be some pain the deficits might grow as tax receipts fall, but as long as government spending doesn't increase, that's the key. And the policies that the new administration wants to implement, the deregulation, the drill baby drill, get oil prices lower, gas prices lower, reinstate the 2017 tax cuts, and of course, gutting the bloated bureaucracy, and that'll free up capital for private investment. All those should, if the new administration gets their way and those policies get implemented, they should take effect sometime in 26 before the midterms. And if that's the case, it'll be just like Ronald Reagan. We'll be in the beginnings of a boom. But between now and then, there's a hiccup. We have the stock market, which it really is not an indicator anymore of real economic growth. It's kind of it's being held up by the AI bubble. There is a chance that the stock market corrects significantly. I'm guessing 30 to 50%. That's not the end of the world. We've seen this twice before. We saw it in the dot-com boom. We had a 50% drawdown over 2 years. And in the great financial crisis, it was a lot quicker because that was a systemic issue. We had a 50% drawdown. We're not calling for a systemic issue. That's always a possibility. And there will be, once the slow economy is apparent to the Fed, they'll chase interest rates down. As I said, we expect inflation to be sub 2% sometime this fall, and interest rates are going to go lower, and that'll have a stimulative effect on the economy, plus all the policies from the new administration. We should see, a boom, hopefully, sometime starting in 26.
So I want to ask you about the stock market and valuations, but before I do that, I just want to continue on the path of the U.S. economy and the debt levels. So they want to cut taxes. At the same time, you're also saying the U.S. economy is going to pull back significantly, go into recession. How's that going to be positive? Like, how are you going to be able to get the deficit down from 6% down to 3% if you...
Well, so Besson said, and he's smart because he knows what's coming, I believe, by the end of 2028. So by the end of, as long as we're exiting 2028 at 3%, we're in good shape. So, there's going to be pain. And there's also the other question right now. The consensus seems to be that interest rates are headed higher. If our scenario unfolds, they're not headed higher. They're headed a lot lower. And Besson has a problem he inherited from the Yellen administration, which her role as Treasury Secretary. She front-loaded the government debt into short-term Treasury bills and short-term notes. They need to extend out the maturities, and that'll be the case if our economic analysis unfolds. Interest rates will be lower. If we're right, the Fed will probably lower another 200 basis points in pretty quick fashion once this scenario is apparent to everybody. And the long end of the curve, the long bond and the 10-year will come down 100, 150 basis points, is our guess. So they'll be able to term out the short-term debt at more favorable rates. There'll be demand in a recession. There'll be a risk-off scenario and a flight to safety. Inflation is going to continue to soar and take off, I think is wrong. I think the juice that we saw was temporary and it's not sustainable. And it's one of the reasons the new administration was elected to take care of this immigration problem, which was stressing so many different areas of our economy. The cities that are going to be impacted the most are the blue cities, the blue states, because that's where a lot of the legal immigration occurred, although there was a lot of an attempt to, feather some of that into red states. So if you're a property owner with multiple rental properties in blue cities, you got a problem.
So, okay, I want to ask you about interest rates. So you think interest rates are going to be coming down. And as you mentioned, Scott Bessent said he wants to get the 10-year lower, but it's been very volatile here in the last few months. I think we saw a low of 380 last fall, got as high as 470. Now it's around 450. But some people are saying that Fed or the Treasury is losing control of the long end of the curve, and that investors are going to be demanding higher interest rates because of some of the very reasons that you talked about, debt levels, deficits, et cetera, and therefore investors are going to want higher interest rates. and 450 is not going to work. Maybe it's five, maybe it's 550. What are your thoughts on that?
Well, if our scenario unfolds, growth slows, inflation slows, risk off, there's no one's going to be worrying about rates going to 5.5. That if we're correct, GDP growth slowing, unwinding of the illegal immigration is going to cause a growth scare and a short-term deflationary blip. Not full-on credit crisis, but if we're correct, inflation is going to be coming down throughout the year, and no one will be talking. Everyone's on the wrong side of the trade right now. Asset allocators are up to their eyeballs in equities. It's been one of the worst on paper bond return in the history, like the last 80 years. The worst underperformance of bonds. Government bonds, corporate bonds, in terms of what's happened with inflation and interest rate rises. So that asset class is not looked upon favorably, but that's a rear view looking mirror kind of attitude. If you look forward and you think our report's correct, and our report is for high net worth individuals, family offices, corporate C-suite people, asset managers, registered investment advisors. If you think we're right, the trade is to de-risk your portfolio and asset allocate over to safe government bonds. Sovereign bonds will be in high demand. And it's counterintuitive, but this always happens in a risk-off scenario.
So let's talk about valuations. You mentioned that you're looking for a big pullback in the stock market, and in the last 2 years have been quite remarkable. The S&P and the NASDAQ have both been up 25% or more in the last couple of years. There's 9 companies now in the US that have a market cap exceeding $1 trillion, the largest of which is Apple. It's over $3 trillion. Something else that really stands out to me, and I just think it's insane, but are these meme coins, and there's thousands of them. And you and I could put out a meme coin tomorrow, but they serve zero utility. It's just all speculation. And they've exploded in both price and popularity. But when you look at the valuations that we see right now, does it remind you of the late 1990s and the early 2000s and some of the craziness that's going on?
Yeah, absolutely. And look, if you look at the value line geometric index, which has got, I think over 1,000 securities in the index, it's a big index. It's gone sideways since its average security, average stock, has not been doing as great as the indices. And the indices have been driven by big momentum tech AI stocks. And, we saw this in the dot-com bubble. At the end of the dot-com bubble, it was very bad breadth in the market, meaning not everything was participating. That's a good bull market has got wide participation. We continue to see more and more sectors kind of struggle, but the big ones, continue to carry the indices for now. If you look at home builders, they peaked in September. They're rolling over. Commodity prices are indicating global economics weakness. Copper's, struggling a little bit. Oil is in terms of real price. Oil is very cheap. It'll get cheaper as a short-term demand recession appears and everybody freaks out. So we're looking for commodity prices to go lower. But basically, the AI, and in our report, we don't even address the AI bubble because that's a well-known phenomenon. But let's just talk. You were around during the dot-com bubble. Let's look at the similarities between the AI bubble and the dot-com boom. So in the dot-com boom, there was all this excitement about these new companies that were going to take over the world. Pets.com, which advertised during the Super Bowl and went to zero. And then I think in 2000, January of 2000, and then they disappeared. So we had all this excitement. The internet wasn't ready for prime time. So we had what was called this bandwidth boom. And that's where a lot of the Ciscos of the world and the Qualcomms and the Lucents and the Nortels and JDS, you remember these stocks. They were all, and you're Canadians, you remember JDS Uniphase and Nortel. Big speculative dot-com boom infrastructure stocks. Funded a bunch of new companies like Quest, Winstar. These companies were called CLEX, WorldCom, and they were building out bandwidth to build for the future internet. And everything became the infrastructure build was super expensive, and it was funded with junk bonds. So it was a good idea at the time, but there were these companies had no revenues. There were no customers. It was all built on spec. And eventually the junk bond market seized, the economy rolled over, and the bubble burst. What do we have with the AI boom? It's infrastructure build. There's no real services yet on the other side. There's no revenue generating. There's no Facebooks or Googles yet. That's going to come. So right now we have this huge investment in building the best AI engine. It requires 40,000 GPU prices per chip from NVIDIA. It requires tremendous amounts of power and infrastructure build. And we all know that right now there's no revenues on the other side. So eventually the capital markets will force that to stop. To make matters worse, a lot of loans are being made to AI startup companies using NVIDIA chips as collateral. So that doesn't sound like a good idea to me because semiconductors are commodities. We've already heard on some earnings calls recently that some of these companies that are building out their infrastructure, like Amazon, have made the determination they're going to start building their own silicon chips to compete with NVIDIA. So this ends like it always does. It's speculative infrastructure boom. There's no revenues yet. Prices will collapse. The debt markets will freeze because there's no cash flows, and then pricing for AI infrastructure will collapse, which is a good thing, right? Because then AI will become ubiquitous, and companies that can take advantage of that cheap infrastructure will offer services. I can envision a company, the way this is probably going to work, and I'm speculating, 3-4 years from now, there'll be somebody that figures out a way to cheaply offer AI services, and they'll start with market segments, like an AI assistant to a general practitioner on their desktop. So this will start, but right now it's just, ChatGPT, Grok. It's basically glorified search engines. And Grok, I get it for, basically free, even though I'm a premium subscriber. It's an add-on feature. It's glorified search. And it's a good search tool, although, AI is a little overhyped. It's a large language model compiler, and it has hallucinations. So you have to be careful. And so, with some of these AI engines, I ask a question, it gives me a lot of information. I ask the same question an hour later, it gives me slightly different information. So it's not the be all and end all. I think it's a great tool. It'll be part of our lives going forward, but it's hype. And then reality comes, and reality comes in forms of bankruptcies and opportunities. Because out of the ashes of the dot-com bubble came the Facebooks, the Googles, and all the host of new internet companies that took advantage of this cheap bandwidth that eventually, was bought. The WorldCom bandwidth and the Quest and the WinStar bandwidth didn't disappear. It was bought for pennies on the dollar.
Yeah, interesting points. I use chat quite a bit, and I'm becoming more and more familiar with it. And I just read recently that Google's search market share of search has gone down. It dropped below 90% for the first time ever. And the belief is that more and more people are starting to use AI like chat or Grok or whatever it is. So it's going to be interesting to see what the trend is with Google search in the coming months and quarters.
Yeah, this is a long-term problem for Google. It's not going to happen overnight. It's what happened to the newspaper companies that they destroyed. Newspaper companies made a lot of their money from help wanted ads and whatnot. Google and other services like Craigslist came in and just destroyed their advertising model. That's why many of them had to go to subscription services, and that's why many of them probably started taking government money to write a narrative. I mean, their business model was blown up by Google. And fast forward, Google now has the same problem. AI could blow up their business model and slowly chip away at their search revenue. And if that happens, Google's stock will see a multiple compression, much like the newspaper companies did. It's going to get cheaper and cheaper with, as time goes on, because growth investors are figuring out their growth is going to slow. So it's going to be a glacial kind of multiple compression. There may be a, in the recession they may miss a number or two, but it'll be a battle. And if I was a BlackRock still managing a large cap growth portfolio, I'd be slowly chipping away at my Google position and going underweight the benchmark kind of scenario.
So when the S&P and the NASDAQ peaked in March of 2000, the S&P lost 50% in the ensuing 2 years. The NASDAQ lost over 80%. You mentioned earlier that you were looking for the markets to lose 30 to 50% this time. Are you referring to the S&P?
S&P, yeah. I mean, obviously, if you're in some of these hyperextended, overvalued companies like NVIDIA, you know, I'm I'm not going to say anything bad about the company. It can still be a great company with a lot of innovation, but when you're paying 29 times revenues at the peak of a semiconductor cycle, it doesn't end well from a stock price perspective. And because it's a bubble stock, it could potentially retrace 80% of what it's gained over the next. I can't tell you how fast it's going to go, but it could do that over 2 years, much like Cisco did. And a lot of the chips that are being sold to AI startups, and existing companies like Facebook, Amazon, Google, Apple, slows. What we saw in the most recent earnings calls was this bizarro, tempering of growth expectations, but we're going to raise CapEx. I've seen this story before. That's what happened in the dot-com boom. Eventually, CapEx will get cut. And the other thing that people don't understand, there's been a lot of double ordering going on with NVIDIA chips. People want to, if you order more, you get pushed further up in the queue so you can get your chips quicker. So some of those orders aren't real, and they'll disappear quickly. This is what happens in the semiconductor cycle, called double booking, double orders. Dirty little secret is NVIDIA has been selling chips to China via Singapore. U.S. growth in NVIDIA chips was starting to plateau at around 20% year over year, but their Singapore business took off and saw tremendous growth. And that was to a bunch of shell companies that eventually found its way into, countries they're not supposed to be selling to. So if the new administration wants to address this, that'll hurt NVIDIA's revenues as well, because it's been going on under the radar.
And the pullback that you're expecting in both the S&P and the NASDAQ, do you think it's going to take 2 years to unfold like it did in the early 2000s?
Well, let's hope. Slower is better. Fast is scary. So, I can't predict, whether it's going to be fast or slow. And again, I'm not giving market timing. This market could go to new all-time highs, going into March, April, before, the market starts to say, aha, something's going on here. So there's another thing going on with the stock market. You'll probably remember this. This is a little unknown fact, broadly. When you and I were back in the day looking at these things, 70% of the volume was fundamental investors in equities. It's now 95% passive and algorithmic trading. So it'll kind of be a surprise to the market, is what I'm suspecting. Once the selling begins, it'll kind of be. That's why it has a chance of going fast, because it's not people looking ahead. It's just passive money and algorithmic trading money.
And in the last few years, it's amazing. You just talked about the strength of this market, right? And we've seen a few pullbacks during the Silicon Valley Bank crisis, and the other regional banks got hit. Then we saw just I believe it was in August, where we had this yen carry trade unfold, and the market dropped 5% pretty quick, but it also recovered fast. And then just recently, we saw another pullback with DeepSeek, and it just kind of came out of nowhere. But the markets can recover so quickly. It's amazing, and continue on to make new highs.
Well, the yen carry trade issue hasn't gone away. Japan, unfortunately, in every cycle, the Fed breaks something. This time, I think they broke the Bank of Japan, because they have a Hobbesian choice. They can either raise interest rates or they can not raise interest rates and support the yen carry trade. So this is the kind of where Japan is at. Japan raised interest rates a couple weeks ago, 25 basis points. If you look at the 10-year and the 2-year in Japan, they keep going higher and higher, indicating that this Bank of Japan is going to continue to raise interest rates in the face of global interest rate cuts, with the U.S. leading. So and the yen carry trade is not so much a stock phenomenon as it is a credit bond phenomenon. A lot of leveraged players globally have borrowed in yen, because the yen had zero interest rates for forever, and it was cheap. from an interest rate parity standpoint and would buy longer, dated paper in other countries. This is a problem long term.
And I just want to summarize a few of the points you made. So first of all, you're looking for a big pullback in the U.S. economy, and then you think it's starting right now, and the U.S. economy is going to head into a recession. When do you think that's going to happen? In the first half or the second half?
That's hard to say. It all depends on, what we see in some of the government statistics. The asset markets might sniff this out beforehand. I'm watching the 30-year bond, and it put in a nice low recently in January, and it's working on what we technically call a monthly swing low, which is a very good buy signal. So if you see the 30-year bond and the 10-year bond start to catch a bid, and no one can really understand why, that's the market maybe sniffing out something's coming. The yield curve is already telling you everything you need to know. We had the longest yield curve inversion ever. We talk about this in our report. But the signal actually comes once the yield curve. That usually happens when the Fed, after an interest rate hike period, they plateau. They did that for about a year, and they start cutting. People think that the 50 to 100, well, I think they cut 100, but people think that those interest rate cuts were due to politics. They were due to the Fed seeing things going on in the system, and they started to cut because real interest rates are still 1.5%, 2%. Money is tight, and that eventually has an effect on the economy. Credit creation is the lifeblood of our economy, and credit creation is going the wrong way.
And this pullback is going to be driven by, I guess, a cessation of this fiscal spending that the previous administration was doing.
Right, and there's going to be feedback loops. And look, in the beginning of the Fed interest rate hike, they went from 0 to 5.5% so fast. It was the fastest rate of change rate hike we've ever seen in the history of the Fed. A lot of the banks have held to maturity bonds that are underwater because of that interest rate hike. That's why we had some bank failures and some scares in March of 23. The Fed then came up with a bank term funding program to help banks get liquidity for their underwater held to maturity bonds. A lot of them just saved government. They lost money on the duration risk. That program ended in March of 24. And so some of those loans continued, meaning that the extension of new loans. A lot of those loans are rolling off. What the Fed will not do is float liquidity for credit issues. And that's where we are. So we've gone from the interest rate duration hit to the credit problem of the cycle. And the Fed's already identified some of that in the commercial real estate sector. They put out a report in November, right after the election, suspiciously, that talked about commercial real estate and how banks have been extending and pretending. So the banks are not reporting the losses, and they're kind of hiding them. The Fed is aware of this problem. And as we roll through the year, more and more of these issues will come to light.
Yeah, you and I might should have a separate interview just on banks, commercial real estate, and also private equity, because I think that's where the next big problems are going to arise. But just going back to what we were saying about this pullback in the economy, you also expect a 30 to 50% pullback in the stock market based on this weakening economy. How are you suggesting investors should prepare themselves for this particular scenario?
Well, in our report, we go into some detailed strategies, but the bottom line is if you're just a Joe Sixpack, and you have a 401k, again, I'm not giving investment recommendations, but, look what Warren Buffett's doing. He has, he was early, but, he's big, so he has to be early. He's got dry powder. And what's dry powder? You go into a money market fund. Every 401k has an option to put some of your, stocks and bonds into a money market fund, and you wait, and then you pick up bargains on the other side or just reallocate into stocks as time goes on. The one thing we need to talk about is this isn't, the recessions are not the end of the world, and we're not calling for a systemic crisis. So I want to be clear. We're not trying to scare people that everything's going to blow up and there'll be a new, new currency and gold standard. We don't know how this recession is going to unfold. If it does look like it'll go systemic, we'll talk about it. But there's tremendous opportunity. Home prices coming down will be a boon to the millennials who are priced out of the market. Stock prices going down will be a great opportunity for you to fund a 401k or an IRA, or if you have a little bit more cash, to pick up some great companies that really overextended, fire sale valuations. That's what Warren Buffett's waiting for. And so, the biggest risk to anybody. So make yourself as valuable to your employer as you can be. Volunteer for overtime work. Do whatever you can. Be the most important person you can be to your employer, so that when the job cuts come, you're at the top of the list of those people to save.
That's a very good point, and that's the way I look at it. I'm really hoping we get a major reset, an economic reset in the U.S. and also in Canada. And the way I look at it is it's a huge opportunity to get in there. And from these opportunities, great things can happen. I mean, we were talking about the tech bubble of the early 2000s. I believe the S&P bottomed somewhere around 700, believe it or not. Now it's at 6,000. So that's the way you got to look at it. The same thing happened in 08, 09. It was it was painful for a lot of people, but at the same time, it can be very beneficial, huge opportunities, and it can be set you up for your lifetime.
Yeah, I'll just give one example. There was I didn't do it because my job was tied to my portfolio. But had I was early in my career, but if I could go back and do something different, I would have bought Las Vegas Sands at $2.20, because within a year and a half it was back to 170. Once the fear gets so bad that you're getting these great discounts that only come once, every 10 years.
So we spoke quite a bit about the U.S. economy. I want to get your thoughts on Canada. I'm sure you've heard Canada's been going through a lot of turmoil here in the last few months, and our Prime Minister, Justin Trudeau, has resigned. But believe it or not, even though he's resigned, he's still sticking around for a few months until they have a leadership race. Do you hear much about Canada when you're in Hawaii, and do you have any thoughts on what's happening here?
Well, you guys have a government that seems to be not good, disconnect of a lot of Canadians not realizing that. So nothing really ever changes. But, for Canada, if the U.S. catches a cold, so will Canada. So I see a lot of opportunities for people who are prepared, who aren't living in la la land. So Canadians who have some dry powder, take advantage of the opportunities. I think, there's going to be some housing pain in Canada because you guys have had some big bubbles. And, like you mentioned, I think it was Toronto, tremendous pressure. And if the ideas of stopping unfettered immigration trickle into Canada, that'll be a good thing long term. It'll cause some short-term economic pain, but I think the average Canadian looks at the price of a home and their taxes, and it's becoming a point where maybe we can wake up some minds.
So, Ed, as we wrap up, if somebody would like to follow you online and check out your services and also the report, where can they go?
Yeah, so the company website is financetechnologies.com. Spelled with a PH instead of an F, and the homepage has got a link to the report right at the top, and you can also follow me on Twitter at Dowd Edward, DOWD Edward, or Getter at Edward Dowd. I post more on X because there tends to be a lot more activity.
I am a follower on X, and I always appreciate your insights. And I would also suggest our viewers check you out on X. And I'm also going to have a link to your recent report in the show notes below. Once again, that report's called The U.S. Economy 2025, Dangers of a Deep Worldwide Recession. Ed, thank you very much.
Thank you so much. Great to be here.